The Korea Composite Stock Price Index KOSPI plunged by 8.77% from the previous session, closing at 2,441.55 points on Monday, marking the largest single-day percentage drop ever recorded at closing. The tech-focused Kosdaq also suffered, ending at 691.28 points, down by 11.3%. Both indices triggered a circuit breaker, a government-imposed 20-minute pause in trading that activates when the index changes by at least 8% compared to the previous session. The KOSPI reached a midday low of 2,386.96 points, following a nearly 11% decline, which came after a 3.65% drop on Friday. The circuit breaker is a more severe measure than a sidecar, which is a 5-minute trading halt activated when the KOSPI 200 futures drop or rise by at least 5% for 1 minute or more, or when the Kosdaq index falls or rises by at least 6% for the same duration. The sharp drop in stock prices over the past 2 sessions was largely fueled by concerns about a potential U.S. recession, particularly underscored by the Sahm Rule following the release of July jobs data on Friday local time. This rule, formulated by the prominent economist Claudia Sahm, suggests that a significant and sustained rise in the unemployment rate is a reliable early sign of economic downturns. Despite Sahm dismissing the likelihood of a recession over the weekend, market anxiety continued into the subsequent trading days. Experts indicate that the Korean stock market may not have reached its lowest point yet, amid continued foreign selling and consecutive declines. They recommend a cautious, wait-and-see approach rather than panic-driven selling. Investor sentiment will be heavily influenced by heightened fear and uncertainty, causing prolonged and unnecessary volatility. It will take some time for investor confidence to recover. This fear is counterbalanced by other market indicators and current supply and demand conditions, which also take demographic trends into account. The U.S. nonfarm payrolls and unemployment rate rising to a 34-month high of 4.3% fell short of market expectations, but suggesting a direct link between these weak market data and the start of a full-scale recession might be somewhat overstated. They emphasized that the much-discussed Sahm Rule serves more as a potential recession indicator rather than a definitive signal of an impending recession. The rule states, the economy has entered a recession if the unemployment rate, based on a 3-month average, is 0.5 percentage point higher than its lowest point over the previous 12 months. Although Friday's jobs report technically aligns with the broader aspects of the rule, it doesn't fully meet all the criteria. U.S. household incomes, consumer spending, and business investments remain strong.